Hello everyone, my name is Allison and today we're going to be talking about accounting adjustment entries. The 5 accounts we will be talking about today in regards to adjustment entries are prepaid expenses, unearned revenue, accrued revenue, and depreciation expense. The first type of adjustment entry we're going to be looking at is for prepaid expenses, in this case supplies. Whenever you're trying to learn how to do an adjustment entry or looking at a new problem, it is always great to start out by thinking of what the initial entry would be. In this case, the supplies account balance on March 31st is $6,000. This means in the past, the company would have had to buy supplies for $6,000. So you're going to think of the initial entry as being debit to supplies for $6,000 and a credit to cash for $6,000 as well. It is important to note that a prepaid expense is not an expense account. It's actually an asset. So when you're making your prepaid expense adjustment entry, you're going to want to debit an expense account because you're using up that prepaid expense. You're using up that asset. And then you're going to want to credit the asset. So in this case, you're going to want to debit supplies expense and credit supplies. Now to find the value that you want to put it as, you need to figure out how much the company has used over the month. In this case, being they say they have $6,000, but they actually have $1,500, you simply take the $6,000 minus $1,500 to come up with the $4,500. The next type of adjustment entry that we're going to look at is for unearned revenue, in this case unearned rent. So the unearned rent account balance on March 31st is $8,500, representing the receipt of an advance payment on March 1st of 4 months' rent from tenants. The way you can tell that this is an unearned revenue account is because that the company is receiving payment for something they haven't done yet. In this case, they haven't rented out to these tenants for the 4 months yet. They're receiving an advance payment. The initial entry on March 1st would be a debit to cash of $8,500 and a credit to unearned revenue of $8,500. The adjustment entry needs to occur because it is now March 31st, so the company has fulfilled 1 month of their obligation to their tenants, which means that you need to take the $8,500 to divide by 4 to come up with a value of $2,125. This is the amount of unearned revenue that the company has fulfilled, so now it needs to be considered actual revenue. So you debit unearned revenue for $2,125 and then you credit revenue for the same. The next type of adjustment entry is for accrued expenses. In this case, the company has accrued expenses for the wages they have not paid to their employees yet of $3,000. For this type of adjustment entry, there is no initial entry. So you have to jump right to the adjustment entry itself. But because the company has accrued these expenses, you need to debit an expense account and then credit a liability because you have not paid them yet, and you are now liable to pay your employees. So here you see that there's a debit to wages expense of $3,000 and then a credit to wages payable for $3,000 as well. Accrued revenue accounts have no initial entry, just like accrued expenses. Because what has happened is that the company has performed a service for another person or another company, but they have not received payment for their services. So they're going to debit accounts receivable for $12,000, and then they will credit fees earned for $12,000 as well. The last type of adjustment entry is for depreciation. And for your initial entry is essentially when you bought the office equipment or your asset. So here the initial entry would be a debit to office equipment, and we're saying that we bought that office equipment for $4,000. And then we paid for that office equipment in cash, so you credit cash for $4,000. The reason depreciation is considered an adjustment entry is because we're adjusting the value of the asset within our books. Even though the books will still reflect that we paid $4,000 for them, after we show that we depreciated that office equipment for $2,500, there will become a new account under the office equipment called accumulated depreciation. And accumulated depreciation is a contra asset, so it will actually show that the office equipment is now worth $1,500. So when you're making an adjustment entry for depreciation, you're going to want to debit the depreciation expense for $2,500 and then credit accumulated depreciation for $2,500. Thank you for watching. If you want to find more of our videos, check out our channel at UIU Tutor, and feel free to check out Upper Iowa University at uiu.edu.